So why does each chunk save you less money each and every time you chunk? Shouldn't it save you more money? Is that how it works? Let's talk about that in today's training. Hey everyone, it's Mike Adams, and on this channel we empower individuals to achieve freedom through improved financial literacy, business ownership, and real estate investing. If you're new to the channel, make sure to click subscribe, click the bell so that way you get notified on any and all of our future content. So this video here, guys, is in response to a question that was asked on the channel. And it was in response to one of our videos, and they were asking, Mike, I see the point of doing these chunks, and at the beginning of the mortgage, it's really cool. You make a big chunk, and it's a huge savings. Why is it less? When you make that second chunk, the total interest savings is actually less than the first chunk. And then when you make the third chunk, it's that total savings amount is actually less than the second amount. What gives with that, Mike? Why is it like that? And so very, very good question. And as you guys know, I love your feedback, love your questions about all the different strategies that we talk about on this channel. So keep those questions coming. I do my best to make as many videos as I can to answer your guys' questions. So here's why, okay? And here's what we know about loans. Let me load this up here. You guys have seen this before on our various trainings. But as we know, on the front end of the loans, okay, based on how they're structured, based on an amortized loan, and then that rate of interest being spread out over that long term, what ends up happening is the loan ends up being front loaded with a bunch of interest. That's why on this example mortgage here that we use, 30-year mortgage, 6% fixed rate, on the very first payment you're sending in of $1,200, $1,000 is pure interest, $200 is it. That's actually knocking down the principal. So on the front end of the loan, that's where you're gonna see the maximum interest savings, is because on the front end, that's where you're getting hit with the most amount of interest, okay? But as you keep making your chunks, or as you progress through the actual amortization of the mortgage, the interest savings is gonna be less because there's less interest being charged. As you can see, just looking at this chart, if you push your mortgage all the way down to where your balance brings you to about that, 24, 25 year mark, okay, as you can see, very little, a much smaller percentage of the payment is actually going to interest anyway in comparison to way at the beginning. So that's the nutshell of why those chunks are the interest savings are gonna be much more drastic at the beginning of the loan than at the end, okay? But just to break down the numbers, we'll pull out my trusty amortization calculator here. And I put in our numbers already. So we got our $200,000 mortgage here, 6%, 30 years, right? And so starting this loan today, if we were to go ahead and make that first chunk, and let's say we came into this thing prepared, we had our line of credit, we had maybe our Discover It card ready to go, and so we make that $12,000 chunk right away, okay, and we can see right now, without making any chunks whatsoever, without doing anything, over the life of the loan, we're going to pay $231,000 worth of interest on this loan. So if we do nothing and just make the payment straight up, $231,000 worth of interest on this mortgage, okay? By making this very first chunk, okay, of $12,000, okay, and moving it over to the line, and now we're gonna use velocity banking to knock down that line over 6 months like we show you, but that first chunk reduced our total interest amount. The total interest amount went from $231, okay, down to $180. Okay, so that first chunk is going to save you almost $50,000 worth of interest, minus whatever interest would be on the line of credit. But again, if you came into this thing prepared, had your zero interest line of credit or offer in tow, you're looking at 0% interest. But again, that's a huge chunk of interest savings. But let's say we knock that down in 6 months. Okay, we got a $2,000 cash flow number, so it's all going to the line, paid on that line to that $12,000 ASAP. Let's go down 6 months. So we got 1, 2, 3, 4, 5, 6. Okay, so we paid it down, and now that same month, we're gonna grab another chunk. 12,000. Okay, so with that first chunk, we saved almost 50 grand worth of interest. We'll make the second chunk. Right now, you can see we're at about 180 in total interest that we'll pay on this loan. Make the second chunk, it drops us down to 144. Okay, so let's go back. So that was 180 to 144. So that's about $36,000 worth of savings on that second chunk. Again, minus whatever interest would be on that line of credit. Okay, but again, we went from a $50,000 savings down to a $36,000 savings. But that's still a $36,000 savings off of the life of this loan. So obviously it still makes a ton of sense, but yeah, that second chunk is gonna be a little bit less because we're moving forward and we're dipping a little bit further into the amortization. And we'll go one more just to show you, just to keep going with it. 2, 3, 4, 5, 6, using our velocity banking strategy. And again, with our example scenario, if you haven't seen that, I'll link below with the main velocity banking strategy so you kind of understand where I'm getting these numbers from. I'm talking about a $2,000 cash flow number. And again, using the velocity banking strategy, we're putting all of our income into the line of credit. So the same line that we're using to bring this $12,000 chunk over, we're using that line of credit as our new checkbook. So all of our income goes into that line, all of our expenses get paid with that line, and it goes down every single month by our positive cash flow number. And in our main scenario, we use a $2,000 positive cash flow number. So that's where I'm coming up with this. So if you haven't seen that video, you may want to check that out. I'll put the link below. But again, let's get this down in 6 months. 1, 2, 3, 4, 5, 6. Okay. And we're going to do a third chunk here of 12,000. Okay, so we went from a $51,000 savings to a $36,000 savings. And now on this third chunk, we're going to go from 144 in total interest paid down to 116. Okay, so that's going to be about a $28,000 savings. Okay, so you're going from 51,000 to 36,000 to about 28,000 on that third chunk. So again, minus any interest that you should be charged through utilization of the line. Okay, but again, if we're playing this thing right, we're able to go from zero interest offer. Here we're only 18 months in, so you may still be on your initial offer if you plan this out properly. But if not, you could roll into a new 0% offer. Okay, hopefully you have one lined up. But either way, we're 18 months in here, and you've been able to save 51,000, 36, and now 28,000. Okay, so that's well over $100,000 worth of interest savings off the original life of this loan. So again, yes, okay, each chunk there'll be progressively less total interest savings, but again, you're still saving a ton of money, over the life of this loan. So again, guys, hopefully you guys found value in this training. If you did, make sure to give it a like, give it a comment below. I will see you guys in the next training.